In this video, we're going to discuss the accounting for investments. And most students at this point have seen debt instruments and equity instruments being used from the perspective of the company issuing them. So, for example, students up to this point have seen the issuance of bonds, okay, and from the perspective of the company, or the issuance of stock from the perspective of the company itself. So we're shifting gears a little bit here because this is now one company investing in the debt of another company or in the equity of another company. So these are clear-cut investments by the company. Okay, so what do I mean by that? Let's start out with debt instruments or investments. These are government securities, like from either the U.S. government or municipalities. This could be corporate bonds, convertible debt, commercial paper. And commercial paper are just basically IOUs from different companies. But what's interesting here or important is that they meet the definition of a security. And what that means is that this is not just an accounts payable, regular trade payable. No, this is something that is based on a contract, is most likely traded and meets the definition of a particular security. So when a company invests in these debt instruments, the accounting for it depends on the intent and ability of management with respect to holding that debt instrument. So in a minute here, I'll show you in more detail what that means. But for now, let's just think about this. Debt investments are, the valuation for them depend on the intent and ability of management. Now, on the other hand, a company can also invest in equity instruments. So in other words, they can buy the common stock, preferred stock, warrants, options of other companies. And then here, the accounting for it depends on the level of influence the management has over the investee. Okay, so notice those keywords right here. Your accounting, the valuation, and many other aspects with respect to debt investments depends on the intent and ability, but then with equity investments, it depends on the level of influence. So let's look at debt investments here. And I know this initially looks a little scary, but let's go ahead and do this step by step. So in terms of debt investments, the key again is to look at the intent and ability of the company with respect to that particular instrument. So depending on that, we have three classifications. We can either have an instrument being carried as held to maturity, trading security, or available for sale. Okay, and the implications in terms of the accounting vary depending on how you hold that instrument. Okay, so for example, if you buy debt of another company, you invest in the debt of another company. If your intention and your ability is to hold that debt until maturity, then you can use the held to maturity classification. So in other words, you can't, if you have the intention of maybe it's a 10-year bond that you invested in, and you have the intention of holding it the whole 10 years until maturity, then you can actually use this classification. On the other hand, if you do not intend to hold it for the whole 10 years, then this is not an option for you. Okay? Trading security. If your intention is to hold that debt instrument in the short term for trading, okay, so maybe you're looking at the possibility of realizing some capital gains from buying a company's bonds and then in the near future, selling it to get a gain on it. Well, if that is your intention, then you would classify it as trading security. And then lastly, the other category, available for sale, basically is the default category if you cannot classify your debt instrument as held to maturity or trading security. So this will be the default if it does not meet the criteria of any of these two. So what are some of the issues that arise here? If in terms of valuation, okay, at what amount do we carry it in the books? If we are holding debt investments under held to maturity, then we carry it at amortized cost. And if you remember, the amortized cost is nothing more than your acquisition cost plus or minus premiums or discounts. So you've been exposed to this in terms of the amortization schedule and the accounting from the perspective of the bond holder. So now you're going to still have to do an amortization schedule, but you're going to look at it from the perspective of the investor now. Okay? If you classify that debt instrument as trading security, then you will carry it at fair market value. And the same thing for available for sale. So in other words, we will need to track the changes in fair market value on the exchanges to see what it is worth. And then each time we have a reporting period, we have to adjust the value. That's not the case if you have it as held to maturity. That's just whatever the amortization schedule carrying value is. That's what we account for. All right. How do you deal with unrealized gains and losses? So in other words, changes in value of the instrument, but not realized. These are unrealized. These are just holding gains and losses as the change in value occurs. Well, in held to maturity, you don't have to deal with this because you are not marking to market. You are not marking to fair market value. But for trading securities and available for sale, since you are marking it to fair market value, then any changes, any unrealized gains and losses go directly to net income for trading securities and then to other comprehensive income for available for sale securities. For all three categories, if you are paid interest during the time that you hold that investment, then it's just regular interest revenue in your books. So that doesn't change with any of them. Okay, so let me give you some examples so that you can contrast these right here. So in the first example here, held to maturity, I'm going to give you an example here as if I had purchased a bond at a discount. Now, we could do the illustration with a premium. It's the same thing. We'll have to change some things around, but you've been exposed to this before, so you should know how to do the accounting if it's a premium. But let's go ahead and look at the discount example. Let's say we have a $100 bond, par value bond. And we buy this bond of another company for $90. So in other words, that other company is selling that bond at a discount. And I'm making up these numbers. We're not going to put any interest rates or anything, just to illustrate the flow of information. I think it's helpful initially. All right, so then periodically you're going to receive interest from this particular investment just because you are the bondholder. So we will recognize that interest revenue earned just like you've always done. And the cash amount is whatever you received, and then the amortization amount goes directly to the debt investment. We won't use the premium or discount like we would if we were the bond issuer. In this case, we're just going to put it into the investment or amortize the investment. So in this particular case, if you notice, debt investment starts below the par value, and as time passes, you're going to add to that value until the point that you get to $100 par value, and that's when it matures. Okay, now this information right here, what amount goes into interest revenue and what amount gets amortized, that's per the amortization schedule as you've done before. And then at the end of each reporting period, if the value, the actual value of the bond changes, we will not do anything on our books. Okay, so keep in mind that that investment, that debt investment that we have, even though we bought it at 90, it could change in value, in fair market value, at any point in time. So since we are recognizing it under the amortized cost, we will not track those changes in fair market value. So nothing is done right here. So in a very simplified world, when I finish, or when the bond matures, I'm sorry, and I will have amortized each one of these dollars until we get to $100 carrying value, that's when I will receive cash from the issuer of that bond. In other words, I will be receiving my cash back from that debt investment. And I have a little note here that, just here, this A, I made this equal A, is the amortized cost of that debt investment. Okay? And the reason I think that's important to note is because even if we are doing, even if we are accounting for this as a trading security or an available for sale where we have to mark to market, okay, we still carry that debt investment at amortized cost. So we'll see how that is in a minute here, okay? So let's do that. Let's go to trading security. Okay, so I buy the same investment or the same debt investment. I pay $90 for it. When I receive interest from the issuer, same thing. Nothing changes. So little by little, the amortized cost increases over time. Okay. Now, at the end of any particular period, and I'm giving an example of a gain, but the opposite will be true for a loss. Okay. At any period ending, we would have to account for those changes in fair market value of the instrument, of the debt investment. So if for some reason my asset is worth more, let's say that this happened right after these two transactions. So technically the carrying value of the debt investment is 91. So if for some reason the fair market value of that bond is 93, and I'm making this up, then you would have a $2 gain to recognize. And the way you would do that is you recognize that unrealized gain to income for $2 or whatever the amount may be, and then you create, you don't put it directly into the debt investment account. You create a valuation account, fair market value adjustment or allowance, whatever you want to call it. It's a valuation account that gets reported with that investment on the financial statements. Okay, so and that's the little note I have right here. So even though you are not going directly into debt investment to increase its value, you do report it alongside that debt investment on the balance sheet. Then when you sell this, I should probably write this. When you sell this particular debt that you invested in, you'll get cash amount of Y, whatever that case, that amount may be, and you'll have to remove the debt instrument. But look, notice how I have the letter A here. You will remove it at the amortized cost again. And the reason that is the case is because anytime you have changes in fair value, fair market value, they're not going into the actual debt investment account. They're going into this adjustment account. All right. And then you may have a loss or a gain. That's why I put it here, where if you have a loss, it's debit. If you have a gain, is a credit here. Okay. Now this fair value adjustment account, fair market. Sometimes people say fair value. I like to say fair market value just to not confuse that acronym with future value. Because whenever I see the acronym FV, for me, that's future value. So it's just my preference to use fair market value. Okay, but it's the same thing when we're talking about fair value, fair market value. Now, the account, the fair market value adjustment account is not done on a how do I explain this? It's done on a portfolio security basis. So in other words, we bulk up. We don't just analyze it for one instrument. We analyze all the instruments in this valuation account here, or this adjustment or allowance account, however you want to call it, is made up of all the other instruments that are being carried at fair market value. So because of that, whenever we have changes in fair market value, we're not going to go directly to each instrument. We're not going to go instrument by instrument and revalue each one. No, we're just going to carry an overall fair market value adjustment account for the whole portfolio of instruments that are carried at as trading securities. All right. And then in the last example, if we cannot classify that debt investment as held to maturity or trading security, then by default, it will be available for sale. And it'll be just like trading security, except that any unrealized gains or losses, and in this case, I did the example of loss, okay? But it's the same thing. But the key here is for you to see how under the trading security, any unrealized gains and losses are going to income, whereas for the available for sale, any unrealized gains or losses are going to equity and eventually to other comprehensive income. Okay, so the flow is, just so you understand, this account is the temporary income account that gets closed into retained earnings eventually, because it is going into net income. Whereas this temporary account for unrealized gains and losses to OCI eventually gets closed to OCI. So that's the big difference. And again, I make the note here that these valuation accounts are for the portfolio of securities, not on an individual basis. And then lastly, whether it's trading securities or available for sale, the moment where you sell that instrument, that's when you have your transaction for cash for whatever amount you received, and you remove the debt instrument at its amortized cost. And then you have a loss or a gain depending on where you stand, whether you received more. If you received more than the amortized cost, then you have a gain. But if you receive less, you have a loss. Okay, so that is the accounting for debt investments from the perspective of a company buying the debt instruments of another company or of a government, etc. So now let's look at how we account for the equity investments that a company makes of the stock of another company. And as I stated before, the accounting for it depends on the level of influence. So let's look at what that means. Let's go to the blue section here. So when a company buys the stock of other companies, they can fall under one of these three categories. And these three categories determine the level of influence. So let's look at what that means. If you're investing in a company and you have a passive interest, then you are going to do an accounting based on the fair market value method. And we'll talk about that in a minute. At this point, you're less than 20%, you own less than 20% of the voting stock, so you have perhaps not a strong say in the operations of the particular company. Now, as you increase your percentage in the company, the percentage of voting stock in that company that you're investing in, then you will be considered to have a significant influence of that company. And while these percentages can serve as a guideline, and it makes it easier for us to be able to distinguish the levels of influence, it's important to note that they are not cutthroat cutoffs. So you might have a 25% investment in a particular company, but you may not exercise significant influence. Now, if that's the case, then it's the company's burden to explain why that is the case. And if that is the case, then they can account for it as a passive interest. Okay, so what are some examples of having a significant influence? And that's what I have right here. So, maybe you have some representation on the board of directors. Maybe you can participate in some of the policy making. Okay, so in other words, you are a particular company X investing in company Y. You're buying some of their stock. If company X exercises some of these influences, then those are clear examples that we should use the equity method for accounting. Okay. Another sign is when you have material intercompany involvement, whether that may be of transactions, of personnel, or other things, then those are good examples of a company exercising significant influence over another. And then lastly, if you own more than 50% of the voting stock, at that point you are considered to have a controlling interest, and the accounting for it is a consolidation. Okay? Now, in terms of unrealized gains and losses, in other words, how that stock goes up and down in value, what do we do with those differences? If you have a passive interest, then any unrealized gains and losses go directly to net income. On the other hand, for the other two categories, you don't recognize those unrealized gains and losses. So it's only for the passive interest or less than 20% category that you recognize the unrealized gains and losses. Now, since you are investing in that other company, how do we deal with the income, the sharing of the income that we get? So in the passive interest, we recognize the dividends as dividend revenue, and we recognize realized gains and losses like we've always done. So, it's unnecessary to even say this, because any realized gains and losses are almost always recognized, okay? Now, here's where it gets a little quirky. For the significant influence category, we will have to actually absorb a percentage of that net income of that other company. And the percentage obviously is depending on what percentage we own. So we will bring part of that percentage into our accounting, and you'll see that in a minute. And then that's not applicable for the consolidation. So let's look at the passive interest category first. Assume we invest $100 in a company and buy $100 worth of their stock. Later on, if I receive dividends from that company, I recognize the cash and increase my dividend revenue. As time passes, any changes in the fair market value of that company, and I'm going to give the example of a gain here, but the opposite is true for a loss, I have to recognize again with one of those fair value adjustment allowance accounts for whatever that difference may be. And the way this is done, I have a note right here. So in other words, we often, we probably never think about this, but how do you value how much that investment is worth? And most of the times it's very clear. If you invest in ABC company, and you buy so many shares of ABC company, at any reporting period, you can always go to the stock market and figure out what that stock is worth, that ABC stock is worth. And then that gives you the fair market value to determine whether you have a gain or a loss. Okay, and if you can have an if you can quote the identical stock in an orderly stock market, then we would call that a level 1 fair value. And the way it works is that the FASB has a hierarchy of fair market values, levels 1, 2, and 3. And they're acceptable, all of these. So in the most ideal place, the most objective valuation is a level 1 fair market value. On the other hand, if you don't have the option to get a level 1 fair market value, you might be able to get a level 2 fair market value. And that's level 2 fair market value is it's a quotation from an orderly market of similar instruments. So it might not be the same stock that you have, but it's a similar type of stock, and you use it to value what the worth of your stocks are. So it's not as reliable as a level 1, but it's usable, and we consider that a level 2. And then when no other option exists, when you don't have a level 1 or level 2 fair value, a company might rely on level 3 fair values. And those are based on internally generated or internally estimated amounts. So in other words, management of the company that's investing, management will determine based on systematic models what they think the fair market value is of that investment. Okay? So there are, we don't think about this, but there are many options according to FASB in terms of how we come up with that fair market value. And sometimes it happens that the investment we are in is non-marketable. In other words, we don't have a way to be able to determine what it's worth at a particular reporting period. So if that is the case, there is an exception. And even though the passive interest category says you must carry that investment at fair market value, if for some reason you don't have a reliable way of determining fair market value, then you can carry it at cost and just test it for impairment. Test that investment for impairment. Okay? But going back to this, here's an example of how I recognize the gains, unrealized gains and losses that go into income. So let's highlight that. And then lastly, if I later sell the investment, same thing. I'm going to have the cash, whatever that may be, and then the equity investment comes out at cost. Okay, and this valuation account that has been used alongside the equity investment, keep in mind once again that this is a valuation account for a portfolio of instruments. So every reporting period, that whole portfolio gets reshuffled, reanalyzed, and then we make adjustments to that fair market value adjustment account independent of this particular transaction. So you will record the sale, take out the equity investment at cost, and not worry about this adjustment account for that particular transaction, because this adjustment account will be dealt with on a portfolio basis with all the other instruments that you hold. So it makes it easier, honestly, when we do that. Okay? Let's look at now how we account for equity investments under a scenario where we exercise significant influence over the company we're investing in. So the method for valuation is the equity method. And under the equity method, when you invest in this company, it's the same thing as in the passive interest scenario. Okay, but then when you receive dividends, okay, this is where it changes a little bit. Where you receive dividends, then you receive that cash and you reduce the equity investment. Okay, and the idea here is you have to look at it in conjunction with this one so that it makes sense. So let me explain that. So if there is net income, if the company has net income, then you will recognize whatever percentage you own of that net income. So if you own 30%, you will recognize 30% of the net income of the company you're investing in. So let me just put here, percentage ownership times net income of the company you're invested in. So that amount, let me call this, let me make this a little bit more clear. Let's call this C instead of net income, because it might be misleading to think that you're recognizing the whole net income of the company you're investing in. And no, it's a percentage of the net income of that other company. Okay, so when you recognize that portion of the income of that company that you have a significant influence on, your equity investment goes up and you recognize some income. Now, this might make more sense when you receive a dividend. Technically, it's coming out of that net income that you recognized. And because it's coming out of that net income that you recognized, it reduces equity investment. So I think when you look at these two together, okay, this one here is how you account for dividends received. It reduces equity investment. But then how do you account for the portion of net income that corresponds to you? It increases equity investment. Well, you can see how these two offset each other because of the fact that technically you're distributing this dividend out of this portion of net income that corresponds to you. Okay, so that's one way of looking at it. And the opposite is true. If it's a net loss, this is what you would do. So might as well do this since we did it before, just to be consistent. Percentage ownership times net loss. Okay, and we'll change this to the letter C here. And notice how if it is a net loss, then that's reducing your equity investment. Now, the carrying value of this equity investment is not going to be cost. So you know how under the passive interest method, when we later sold that equity investment, this came out at cost. Well, when we later sell this, if we choose to sell it, when we later sell this equity investment, it'll come out at the carrying value, and the carrying value determined using the equity method. So while this one is the carrying value at cost, this is the carrying value at equity method. All right. And then again, you have a potential gain or loss with that scenario as well. And then I have a little note here that says if we are recognizing net loss, or our percentage of the net loss to be more clear, okay, then the amounts that we reduce equity investment by is limited to the investment itself. So in other words, we're only exposed, or we're only risking up to the amount that we invested, which is $100. So if all we see after we invest is losses and losses and recurring losses, every time we recognize some of those losses, it's going to reduce our $100. And we will do that up to the $100. So that's what I mean here by limited to the investment carrying value. Now, there are scenarios where you might be able to continue to credit equity investment beyond your investment, but that's not common, and it would be in a scenario where you issue further guarantees than your initial investment. So, you know, that just sounds complicated. But normally when you invest in a company, your exposure to loss is whatever your investment is. That's as far as you'll go. But in the scenario of companies investing in other companies, sometimes there are arrangements where they are exposed beyond that 100 original investment. And if that is the case, then we can continue recognizing more loss, if there is more loss. Okay, so the last category is whenever we invest in a company and we have a controlling interest, okay, legally controlling interest, or you know, when we own more than 50% of the voting stock. And what we do, I said, is we consolidate. The parent company, the one that's investing in the subsidiary, will consolidate and bring all those financial statements as one. And that's a topic for a more advanced financial reporting accounting class. But do understand that that is another way of doing the accounting for that. All right. So it's you know, let me just kind of recap, because it is interesting how we have so many different valuation approaches. Just in this conversation here on accounting for investments, we have one approach is amortized cost. Another approach is carrying something at fair market value. Another approach is carrying something at the equity method value. And based on your previous knowledge in accounting, you've also seen other valuation metrics. Okay, when you look at accounts receivable, for example, accounts receivable is carried at the net realizable value. When you think of inventory, inventory is carried at the lower of cost, or NRV, or sometimes the lower of cost or market. So in other words, what I'm trying to get you to appreciate is that a set of financial statements has many different valuation metrics, and that makes it complicated for some people to really comprehend. Not so much the accountants, but the non-accounting trained individual. Because we think, when we first take accounting, we think everything's carried at cost on the books, and that's what we're told. But that's not true. There's many different valuation metrics that we use besides cost. Even cost itself can be deceiving, because here I'm saying amortized cost. That's not the same as historical cost, right? So, you know, it's a whole bunch of different valuation metrics that we see in a set of financial statements, and we got to be aware of how each line item is being valued. As accountants, we need to understand that. Okay. couple other topics that I want to mention here with respect to accounting for investments. The first one is the fair value option. Okay, so besides having the accounting rules that I just described, there is also something that allows companies to carry financial instruments at fair value if they choose. So in other words, the rules may dictate that you have to categorize something as held to maturity. Okay, so that's one option. But then under this fair value option, you may actually choose to not carry it at amortized cost. You might say, you know what, even though my intention is to hold it to maturity, because remember, for debt instruments, it's intent and ability, right? So even though I intend to hold it to maturity, I want to carry it at fair market value. And if that's the case, you are allowed. So this idea of the fair value option gives companies the option to carry most financial instruments at fair market value. And then the changes go directly to income. And this is not just available for the instruments that we talked about. So here I say it's available for held to maturity, available for sales, instruments that are carried at equity method, but it's also available to just regular notes receivables, notes payables, any type of financial instrument that you want to carry at fair market value, you can choose so. Now, here's the kicker, or here's the thing where you got to be really careful. This choice has to be applied from the get-go. So from the moment that you make the purchase or you incur a liability, you have to make that decision if you want to carry it a fair market value option. So it's not like you've invested in some bonds of another company and 2 years have passed and you've been carrying it at held to maturity, and all of a sudden you want to change to the fair value option. Usually that's not how it works. You would have to have chosen that from the get-go. And then the other thing that's makes it tricky is that you cannot go back. Okay, it's irrevocable. So you must continue using the fair value option until you dispose of that particular instrument, whatever that may be, any of these. Okay, now another thing that makes the accounting a little bit intricate with this is that the changes in fair market value, all these changes, must be applied on an instrument by instrument basis. So if you contrast with what I said a few minutes ago, where if we use the portfolio basis, we have a fair market value adjustment account that just sort of tracks everything overall in terms of increases and decreases, and it nets it. If we choose the fair value option, we cannot group things together. We have to actually analyze every instrument on its own, and the changes will be directly into that investment account for the one you chose, the fair value option. Okay? Now, what's quirky about this idea of the fair value option is that you could have similar instruments. So in other words, you could have invested in bonds in company ABC at one point and accounted for it as held to maturity. And then later on, you might have bought more bonds of that company. Later on, at a different date, you might have bought more bonds of that same company and chosen to use fair value option. So you might have similar financial instruments with different valuation approaches. And that is kind of weird. Here I'll have a little note on the side. If you do choose to apply the fair value option to the equity method, let me remind you a little bit about the equity method here. Under the equity method, net income increases the equity investment, and then dividends decreases the equity investment. So this is where we track a percentage of the income of the company we're invested in. Well, if you decide instead to not use the equity method of accounting and choose the fair value option, then at that point you don't recognize that percentage of income. Okay, no longer, you don't do that. All you do is just recognize unrealized gains and losses from changes in fair value. And then any dividend that you receive does not affect the investment itself, it's just going to be dividend revenue. So in other words, if you choose to not use the equity method for an investment between 20 and 50%, and you choose the fair value option, the accounting is going to be very similar to the accounting of an investment, equity investment of less than 20%. Straightforward here. If we do choose the fair value option for whatever instrument it is, if we have gains, they go straight to income. If we have losses, come out of income. But the other side of it is directly into the debt or equity investment itself. We do not use a fair market value adjustment account. Let me go up here. We do not use something like this, like we did here under passive interest. We do not use this as well. So let's be very clear on that. That those changes will be recorded straight into the actual account. So when you look at the balance of debt or equity investments carried under the fair value option, they will be as of the last reporting date at the fair market value. Okay? And then lastly, impairments. Okay, so we can, whenever we're dealing with assets, and investments are assets, okay, so anytime you are accounting for investments, the investments themselves are recorded as assets. So anytime we're dealing with assets, we usually are thinking about the potential for impairments. Okay, so let's talk about that for a minute here. If we are dealing with held to maturity debt instruments, we're buying the debt of other companies as an investment. At any point in time that we assess there is a credit loss, okay, in other words, we're going to lose money. Something happened and we're not going to be able to collect on that debt. So if we recognize that it is probable that we're not going to collect, and this key word here, probable, then at that point we recognize a loss and we reduce the investment itself. Straightforward. Okay? And for the held to maturity, that's important because remember, the held to maturity instruments are carried at the amortized cost. So we're not marking held to maturity to fair market value. So at any point in time where we have a potential impairment, we want to take that loss and reduce the debt instrument. For trading securities or equity investments under 20%, if you recall, those changes in fair market value are constantly going to income. So we are marking to market with these items, and income is reflecting that as we go. So we don't need an adjustment here because we are constantly adjusting for the fair market value. And then the available for sale category, right here. This one gets a little bit more technical, but here's the idea. If you have a credit loss that you need to deal with under the available for sale category for debt instruments, recall that this is debt instruments. So you have the possibility of not collecting on some of them, some of the cash flows from that debt instrument. If the fair market value, so this is the losses, the big picture is that we might have a limitation of the loss that we have to recognize. Notice how here we recognize the whole loss under held to maturity. Under available for sale, we may be able to limit the loss recognition. So if the fair market value is greater than the amortized cost of that debt instrument or that debt investment, think about it. You might have a risk of credit loss. In other words, you might have a risk of uncollectability, but if your asset is worth more than the amortized cost on your books, then we're not going to recognize a loss for that credit loss. And the idea here is, and this probably should be more here than at the bottom, you can sell this stuff. You can sell that debt investment. So why recognize the loss when you have the opportunity to sell it at a greater value? In other words, you're not exposed as much as you are under the held to maturity accounting environment. All right, and if the fair market value is less than the amortized cost, then you may have to recognize a loss, but it is limited. Okay, so in other words, your debt instrument is worth less than what you have it on the books for. And you might have a loss that you need to, a potential loss of uncollectability that you want to recognize. Well, that loss that you recognize is going to be limited. And the credit loss recognized is limited to the amount Z. I should have put Z right here. Let me change this real quick. And what is Z? Z is the difference between the amortized cost and the fair market value. So, in other words, even though your debt investment is worth less than what you have it on the books, it's still you still have the ability to sell it at this value right here, right? So because of that, your loss is going to be limited to just the difference between these. So what I'm trying to say here, and I know this may not be too clear, let's say that I have a potential credit loss of $100 or $100. Okay, so in other words, I would normally recognize a loss for 100 because I don't expect to collect $100 of that debt investment. But if the fair market value of that debt investment is $90, and well, no, let's not. Maybe I gotta go a little larger than this. $900, but then the amortized cost, and I'm making these numbers as we go, is in this case $960. So in other words, the debt investment is in my books at $960. It's worth $900. I have a potential credit loss of $100. Do I recognize the whole $100 like I did under the held to maturity approach? And the answer is no. We're only gonna, even though we're exposed to 100, we're only gonna recognize a maximum of 60. The difference between the amortized cost and the fair market value. And the idea again is, at the worst case, you could sell this for the fair market value right now. So only recognize the difference that takes you to fair market value. And then later on, you can actually recover some of these losses if you deem that collectability improves. You can reverse some of these up to the amounts that you've recognized in losses, like in other environments where we limit the amount we can recover up to losses in the past. Okay, so this concludes the video on how to account for investments. Big picture things, debt investments, we got 3 categories, and the categories depend on the company's intent and ability. And then with equity investments, the accounting depends on the level of influence that the company has.